Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Welcome, everyone, to episode 37 of Offshoot. My guest today is Shlomo Chopp, the managing partner of Case, a distressed commercial real estate advisory and investment firm. Shlomo and his team are currently working on about 20 loans, totaling over $2 billion of debt. And he's part of a family office with over 35 years of experience owning and operating roughly 70 properties across the U.S. Shlomo's origin story is gold. It reminds me of what really matters. He's a college dropout with no formal finance training who got into workouts when the market cratered in 2010 and there were no deals to be done. He cracked open the CMBS loan documents, taught himself the intricacies of structured finance, and just went out and did it. Since then, he's invested in, structured, or advised on nearly $5 billion of commercial real estate. Shlomo's got a unique vantage point in the market. He's seeing deals break, capital stacks unwind, and borrowers make mistakes that most practitioners never encounter because they're only involved when things are going well. Shlomo's the guy you call when things have gone sideways, and his role is fundamentally one of translation, bridging the gap between the language of the operator and the language of the lender. He's fast, he's blunt, and he's incredibly generous with his knowledge. For the audience, you might want to put this one on 0.75 speed. He's clearly sticking to his East Coast roots, and we're drinking from a fire hose. Listen in as we cover topics that include how Shlomo's role is primarily one of translation between the language of the operator and the language of the lender or the lender's legal counsel, and why that gap is wider than most borrowers realize. Why gaming out the myriad of potential outcomes, not just your own moves, but the lender's responses, the market signals, and the appraiser's perspective, is central to navigating a complex real estate workout. How the process of negotiating loan docs is best done slowly and with deep respect for the implications of poor drafting, and why time may kill deals, but speed kills. His assertion that 70% of real estate owners can't be bothered to go through the what-if scenarios that are part and parcel of navigating real estate's complexity. That opportunity is complexity, and that binary thinking is the challenge. If your business plan is waiting for the next guy to take a loss, that's unlikely going to work. Shlomo's baseball analogy for where the commercial real estate market sits today, a scoreless game in the fourth inning where every ball hit has gone to the track and been caught, and why, if losses start to materialize, it may signal a pullback in the equity markets. The rolling implications of not reading your loan documents, from cash traps to inadvertent recourse triggers, to losing your building over $750,000 you never should have owed. The importance of empathy in his work and how a genuine desire to help people, not out of altruism, but out of a deep satisfaction in making a difference, has been one of the engines behind his business growth. And finally, why the wisdom of those who've gone before us, from Winston Churchill to Howard Marks, is worth collecting, and how the quote, "When the time comes to buy, you won't want to," might be the most relevant advice for today's market. Shlomo drops a ton of hard-won insight in this one, and there's a lot here for anyone navigating complex capital stacks, considering a workout, or just trying to understand what's really happening beneath the surface of today's market. I hope you enjoy it. Shlomo, good morning. Thank you for, I guess morning for me, it's afternoon for you, but thank you for taking the time to join me today.
It's my pleasure. I appreciate you having me.
Yeah, look, I know you're busy, so hopefully we can settle into a nice conversation without too much work. But for the listener, and candidly, you and I got introduced kind of cold, but we've got some mutual friends. Tell us about Case. I think you've got an advisory business over there, and also an equity business. But tell us about Case. What do you guys do over there?
So Case's business is, I'd say, about 90-10, 90% advisory, 10% investments. We're opportunistic investors. But on the advisory front, our focus is on distressed commercial real estate, specifically around more complex loans. If you think about it, back in the day, a mortgage was a mortgage and a note. Now there's a mortgage, a note, there's a loan agreement, there's an assignment of rents, there's guarantees, there's non-recourse carve-outs, there's assignment of agreements, all types of things. And not only do you see that in CMBS, but you see it across many other loans. Fannie Freddie, you see it in banks being more specific around cash management. And borrowers just aren't prepared. They're good at what they do. And I think people sort of discount the need to really prep and understand how to work some of these things out. So that's what we do. We assist them with it. I'd say typically a borrower has to go through a bad experience before they come to the table and say, I might need some help over here. But hopefully a podcast like this helps people sort of, understand about what's involved. So that's primarily the work we do. And then we get involved in investments very opportunistically, very selectively, not because we don't want to buy up the world and, add to our portfolio. It's just that, we're in it not for fees, we're in it for value appreciation, and we're very selective about we want assets that actually survive the test of time, so to speak, not just trying to fill a fund. So that's us. That's what we do. And right now I'd say 90% of my day, 95 to 98% of my day is advisory. We're working on about 20 loans right now, over $2 billion of value, settle on the value debt amount. And yeah, that's us.
I had another gentleman on the podcast a while back, and he's in a related space and used the sort of visual of Pulp Fiction and the wolf, right? You call the wolf when everything's gone wrong, and he comes in to do the cleanup. Sounds like you're
I
similar.
I know that laugh makes it sound like it, but no. Listen, here's the thing. It's not so mysterious as people may think it may be. It's really understanding the language other person is speaking, right? It's sort of like, something that may be accepted in the US culture. If you go, for example, to a Far East country, it's not accepted, right? And so on and so forth. So it's the same thing dealing between an operator and a lender, right? There's a different perspective you come from. Like your lender doesn't have any visibility. And when he doesn't trust the visibility you're giving them, then you got a problem. So you need to not only give them the visibility so that they feel comfortable with you, but you got to allow them to come to the point where they're aligned with you in, what the property needs. And once you figure out what the property needs, the question is who gives it to the property and what's the right approach. So I would say it sounds mysterious. It sounds like a fixer. It sounds like that, but not really. But there is obviously a lot of knowledge, a lot of technical knowledge, and a lot of it is just gaming out. And I think, our society business wise has become, at least in real estate, has become a lot of deal making. So people don't just game out. They go and they sit down. Okay, let's see what he wants. I'll react in real time. I go, my gut. Well, that's great. Except your gut is totally ill informed when you deal with a lender, right? It's not, your gut is not going to be what what you think what you think is right. You're probably going to be wrong. I know that you as a borrower probably can't hear that because you're this, great developer or owner, and you've done a really great job in what you've done, and you see the reality for what it is, and you're telling the lender how screwed they are, and that's fine. But at the end of the day, you got to make the other guy come along with you for the ride.
When
And
you
in
when
order
you
to
say
do
game
that,
it out, you're talking kind of game theory, decision tree. Like, okay, we're going to go A or B. If we go B, then we've got C or D. If we go D, we've got like just sort of working through all of the potential outcomes. Is that what you mean by game it out?
yes, but you only gave me one perspective gaming it out. That's what I'm
Right.
going to do. But then I got to game out what the guy's going to respond to. But then I also need to game out what the market's going to say. And gaming out what the market's going to say has a lot to do with what the BOVs are going to say, the brokers are going to say. So that games out based on what investors are looking for. At the same time, you need to game out what the appraiser is gonna look at, right? And how they're going to come to the table. And then you need to game out how all that is going to feed right back into your decision making on the lender side. And then you need to say to yourself, okay, what if this happened? Then you go and deal with it from there. So yeah. So it's a lot deeper, and most people just, can't you just call the guy? Can't you just work
Right.
something out? I'm like,
Right.
no. Yeah, I could. The answer is going to be no. Yeah.
So we recently got involved in a deal that had a bankruptcy file, and um, there's a it's enticing to develop a narrative and say this is what's going to happen, and then at the same time it's really clear that that's only one of a myriad of potential outcomes. It sounds like that's the space you're trying to navigate. Like, hey, it could be that, but it could also be this, it could also be this, and let's prepare for all of
Right.
them.
Yes. Now, someone may say, BS, there's no way you're preparing for all that. And the answer is yes, I am. But you know how I'm doing it? I'm taking things off the board, right? That's the process of elimination is the best way to solve for it, right? So it's the same thing like Occam's razor, right? You take the most probable solution, the most probable explanation, you go with it, right? You sort of need to work backwards. The problem with if I'm a developer, if I'm an owner, I don't understand how to assess how the lender is going to think about things, and therefore, it's very hard for me. It's very hard for me to then game out his response, and that's
Uh-huh.
where it breaks down. But knowledge alone isn't enough, right? Knowledge is great, but then you got to put that knowledge into the hopper and mix it around and turn it into something.
And just for getting clear on what you are and what you aren't, you guys are not court appointed fiduciaries. You are not a receiver.
No, I'm not a receiver. I work for the borrower. The borrower retains me, and my goal is essentially to provide. And again, we don't take on every borrower, okay? Because I mean, let's step back here before you ask me a question. I'm quote unquote a receiver or work for the borrower. Work for the borrower, but let me sort of explain a little deeper on that. So first off, I just explained how we go through game theory, right? I'd say 70% of real estate owners, by count, um, cannot go through that process with us. I don't know what you're doing. Just do this. Just do that, right? You hired me or you do want to do it, right? Make up your mind. So then we're hired by borrowers, and the goal is when we have a more cerebral borrower, someone that understands, is someone that's prepared to learn, someone's prepared to go through the process. And I don't know more than them when it comes to operations, but we do know more than them when it comes to dealing with lenders and how to bridge that gap. If someone's that type of an individual, then we work to accentuate their positives. We work to come up with a plan that can turn around the property to the benefit of the lender and for the benefit of themselves, that highlights their strengths to try to illustrate to the lender, you know, how this works for them. So we've had many situations where the lender's going down a path of aggression and you just literally flip it on its head, right? You just got to highlight what this guy's doing, right? And he's doing a good job given the circumstances, right? And that's what we do. So we take good borrowers who are find themselves in bad situations, and we use what they bring to the table that's a positive, and we highlight that to the lender. And sometimes the lender says, "Okay, that's great. So you're the best case scenario. I still don't like it. Take me out." Right? Or sometimes they say, "Too late." that
Too late.
I try not to get into that situation. I try to head it off at the pass, so to speak. But yeah, that's
That's
our
super helpful. So let's talk about today. Like, what are you guys seeing? I think we're in a really, so let's do this. It's April 23rd, 2026. What are you guys seeing in the market? Where are the opportunities? Where are the challenges?
okay. So I think the opportunity is if you no, because it's not a binary answer, right?
It's
I
not a
can't give you
simple answer.
buckets.
Yeah. Yeah.
I'll tell you why, because the buckets, I gotta first explain what those buckets are, right? Like, and I could tell you so many people out there looking for investments, their buckets are not gonna be what they're gonna buy. they're going to have to pivot. So I think the opportunities, well, I would put it into buckets, opportunities and the complexity. That's where the opportunity is. The challenges are in the binary, right? If you want the next guy to take a loss, do you think he's an idiot? If that's the case, then okay, great. He may just be an idiot, but if that's your business plan, that's not going to work. The opportunity isn't the complexity. The opportunity is when you can take a problem that other people view as insurmountable and therefore don't want to focus on it. And you could focus on it, identify what the problem is. That's step number one. And then be able to solve that problem, not through brute force. I'll give you X. If you don't take this deal, then I'm walking, and he doesn't have anyone else to go to. That's great that you succeeded despite yourself, right? You're really not adding value. You need to bring the guy over to your side of thinking. And this is a tough thing to do in distress, right? Because it's not like I'm about trying to buy a deal, right? And the guy wants 10 million bucks. And I tell him, listen, I'm at 9.4 top dollar. That's it. And, he wants to sell at 9.4 works for him. 10 million works better, but okay, he'll do 9.4. No, she's saying here, not that you're making a profit. No, here's how big a loss you're going to take, right? You're trying to convince the guy to take a loss. And sometimes you could get him to take a loss, but you can't walk in saying you're going to take a loss. It's very simple, right? You need to be able to, it's a long process. And people talk about, time kills deals. Time doesn't kill workouts. Actually, time makes workouts, right? People realizing what's going on makes workouts. It's also, the more you fight, it's like a seatbelt, right? The more you tug on it, the tighter it's going to be. Sometimes you got to give them what they want and understand that Rome wasn't built in a day. And even when the guy fiddled, it didn't burn down in a day. So, at the end of the day, it's not, well, I used day about 7 times over there. But the point is that it's a process. It's a process. And you got to come prepared. You got to prepare to execute, and you got to come prepared to improvise. And without preparation, you got nothing. And that's the challenge, because you get all these deal makers going in and saying, okay, we got this property. We tried chasing it for a long time, and now we're screwed. So let's just tell the lender this is where we can get a deal done. Let's see if it's realistic. It's a waste of time. Let's move on. You know what you just did? You just abdicated, or you just gave away an opportunity to be the sole competitive bidder on your asset to turn it around. And now you're losing it to someone else who's going to make money off of it. And you'll always say, well, he just wasn't ready to do a deal with us. But yeah,
But it's if I'm hearing what you said from the top there, it's the fact that you made it binary, right? Hey, here's the price, take it or leave it. Okay, that's your challenge. Your opportunity is not being binary, coming in, like getting close to them, explaining things, building common understanding, and then seeing if you can actually solve the problem.
Absolutely. And right now, anyone listening to this is going, come on. Like, how do you do that? Why is the guy going to sit talk to me? There's a million people trying to do a deal. Why wouldn't you put it on the market? Okay, so don't put it on the market. You'll still be there at the table and you can still get it done. And then the question is like, okay, how do you not make it binary? Well, just not showing up in the guy's office and offering him a low price, a low deal. If you avoid that, that doesn't mean you didn't make it binary. I mean, you just decided not to do it in an abrupt, antisocial manner, which is good for you. Thank you. You passed test number 1, right? But it's only test number 1. You actually need to position it into a situation where you can get him on board. So I could tell you, like back in the day when I started in CMBS and the special servicers back in the day, they'd go, yeah, give me an offer, and give them offer. They go, no. And then they'd go, okay, give me another offer if you want to give me an offer. Otherwise, for closing. And guys would go in and give another offer, and they'd say no, another offer. And they say no. And then negotiating against themselves. And I'd be like, okay, I'm clearly not going to get him to counter me. Okay. I'm clearly not going to get him to say yes to whatever offer I give him until I hit some magic number. He goes, this sucker may actually close. Right. But how do we get to an offer? So I'd go and I'd argue the inputs, not the outputs. I'd say, okay, listen, I get it. I get it. This offer wasn't enough for you. Okay. Furthermore, I also know you're not going to give me a number in return. Okay. I'm not asking you to do that because you're afraid you're leaving money on the table. Let's talk philosophy around this deal. Right. So here's the challenge we're having with leasing. And our TIs are X number. We have the brokers giving us opinion around Y number. So a real challenge over here is you got to put an X amount of dollars, and this is how it works out. And by then I've given him like a book on the assets, looking at it from multiple perspectives, really giving him a 3D vision to the extent the guy even read it, which is an issue. But my purpose of giving him the book was not necessarily for him to read it, but rather to deal with the appraiser to make sure the appraisal came in at the right number as well. But putting that aside, I'd start arguing the inputs. That's something he could talk about, right? And I'd be like, okay, theoretically, let's put the number aside. you prefer if we do some type of restructure? You want to get out of the deal, right? And he's like, I don't know, do what you want, right? So then you could always fall back on, you know what? I have an idea. You don't want to make a decision? Here's what we're going to do. I'm going to make you make a decision. I'm ready to sign over the deed to you, right? Here you go. Okay. So you're ready to sign over the deed to me. Now I got to say yes to something and say no to another deal. That's the most powerful thing. When you're begging for something and the other guy's got all the power and you could take away his power and say, hey, I'll give you the deed, and you really mean it. See, that's the thing. Like any lender listening to this goes, oh, Shlomo, that's your game. First of all, I don't do it often. Okay. I only do it when you're a miserable introvert and you don't want to talk to me. Okay. Let's just start right there. Okay. Secondly, and they're by the way, a lot of those guys have left the industry, right? I even have, like, depending which service I talk to, I'll say, oh, that was a that guy type of response, wasn't it? But the point is, like, a lot of those guys are out of the way. But if you're not a miserable introvert and you can actually realize that we're trying here and you give me a position and you tell me, like, Shlomo, you got to be higher on that because we're in that range, or it's got to have a 6 in front of it, and you got a 4 in front of it, and we got an issue. And I know you're BSing about the 6, and you know that I got room on the 4, so we could end up somewhere in the 5s, right? Like, we know we were going, but they're not going to do that absent them respecting the person on the other side of the table. But if you're a borrower showing at the table trying to go it alone, you're not going to get respect unless you show that the reason it's in default is a property issue and you're part of the solution, not part of the problem, right?
Right.
That's going to be the key thing. And if you cause the problem, you don't get to capitalize on that problem, at least in their eyes, right? So when you come to the table, you better be prepared with an explanation as to what happened, what's happening, or what needs to happen moving forward. And that's if no one who's at the table today existed. The property, the economics of the property in its market. That's the story. Now the
You're solving
question,
the problem at the property level and making sure that the borrower isn't associated with it. Like, meaning they didn't cause the problem and they can be a part of the solution.
yes, I'm basically saying, let's look at it from a 60 foot, 600 foot. Let's look down from a helicopter. Like, this is where the property is right now. And by the way, we didn't bring it to this point. And I'll show you and I'll prove it out. I'll be open book with you. Obviously, you got to be careful on some of that stuff. Be open book with you, and I'll prove to you that you're really screwed. That's really what it is. I'm not going to prove to you that I was amazing, because I'm never going to prove that to you. But I'll prove to you that it wasn't me that ran it into the ground. And I'll also prove to you that you can turn it around at a better return than I can, right? So it's better if you take my money as part of a restructure or even a discounted payoff or something, and then let me deal with it and let me deliver for you better. And you won't look negatively at me as a result.
So you're getting into a whole bunch of really interesting philosophy bits and like how to navigate the relationships and how to position the distress so that somebody can start to like pick it apart and perhaps get uh, in motion about resolving property level issues. More specifically, again, just being April 2026, like what asset classes, what vintages, what kind of capital stacks, like where are you guys seeing distress, or perhaps in your business, we call that opportunity. And then where are you seeing challenges? I got what you're saying is like the opportunity is the complexity and being binary is the challenge. That's almost a philosophical answer. I dig it. But like where in the built environment are you seeing things kind of stuck?
So I think so it's very hard to fight a market. So obviously office is a problem. But if
Hmm.
you have money today, you can lease up office. But then the question is basis and time, right? So that's a problem. Obviously, multifamily was bought at the height of the market, 21, 22. You got a problem, right? Any asset that you haven't invested into it because you've taken advantage of high interest rates to return money to your investors, that's a problem. But that one builds into the real bifurcation between the good operators and the bad operators, right? And a good operator may not be a good sponsor to his to his LPs, meaning, let me rephrase that. A good operator doesn't mean he's a good GP. It just means he's a good borrower. a bad operator doesn't mean he's a bad GP, right? Meaning you could be a bad operator and return 6x you could be a bad operator and return 6x to your investors, right?
Mm-hmm.
Um, to your lender, you're probably decaying the asset over time. And ultimately the lender has got a maturity at the end of the day. So I think what you're looking for, where there's the stress is driven by asset class and market, which I don't have to tell you that Chicago is an awful market. I don't have to tell you that New York City multifamily is an awful market. I don't have to tell you that Los Angeles office is terrible. I don't have to tell you about, various other markets where the asset classes have an issue, right? I don't have to tell you any of that. I also don't have to tell you that if you financed on a bridge loan to acquire in the South in 2022, that you probably are in default multiple times over and triggered recourse with those predatory loan documents, right? I don't have to tell you any of that. But what I could tell you is that if you're a good operator, you've maximized the potential of the asset. If you're a bad operator, you haven't. And if you tie that directly to leverage levels, that's where you find the most distress.
There you go. Yeah, that lands perfectly. The good operator who had maybe slightly more than optimal leverage may pull this off. The bad operator at that same leverage level is probably in trouble.
Yep.
Yeah.
Yep.
I wanted to bring this up later on, but since you just kind of gave me a segue, you had mentioned predatory lending documents. I was on, I think, your website the other day, or maybe it was an article linked to like Globe Street, but you were discussing recourse. And you make this distinction of like above the line versus below the line recourse, which I think the way you speak to it is above the line recourse is recourse for the damages that you make and you're sort of liable to correct those. Below the line is, okay, now the entire loan has become personal recourse obligation. Let's dive into recourse. Look, it's like the billboard on the highway, right? And you had just said, a lot of these developers are really good at what they're good at, but they might not be as good as I am translating from their language to lender language to make sure that there's a single conversation being had. I think recourse is like the billboard on the highway, and the developer's like, yeah, I want a non-recourse loan. But I mean, let's start with this. Does a non-recourse loan really exist?
Well, at its core, every single loan has a guarantee. They're just carve outs to that. There are essentially exclusions to the guarantee, and then there's carve outs under which those exclusions don't apply.
Right.
Right. So deep down beneath everything, there's a guarantor and a guarantee. And you just need to make sure that the scotch tape and chewing gum that you use to patch up the hole at the bottom of your ship is actually going to hold. And, it's not gonna start leaking on you. So, suppose you're the borrower that basically decides to upgrade his LEDs in his building and decides to finance it. Oops, full recourse. So, there's a lot of challenges that happen when you don't pay attention to your documents. And what's worse, there's a lot of challenges that happen when you don't hire the right attorneys to draft those documents to begin with, because the first time you'll pay attention to those documents is when you want to make sure that you give back the property to your lender clean and say, oh my gosh, we got a problem. Or the lender says, oh, not so fast. You're fully guaranteed. You got recourse. All right. So I think the nature of, the loan's non-recourse. That's like me saying, hey, how's the real estate market?
Right.
So,
It's
it's a
good.
nice broad, it's a talking point. Yeah, for me, it's good. For you, it sucks. So, yeah, great.
Yeah. Uh, Look, you're in a unique vantage point though, where you're seeing deals break and it's when, or come close to breaking. And that's when all of those really finer points like come into more black and white, stark relief, right? Um,
Yeah.
y- you know, I just was looking at loan docs the other day. Just the guarantee language was 23 pages. And it's not to say, that it should be otherwise. But how do you think about advising developers, entrepreneurs, investors, uh, other than what you just said in terms of having good attorneys? Like these things are these things are anything but simple. I mean, that's just the guarantee section, 23 pages. How do you, or just say it this way, you're having beers with a friend, like, what's the straight up advice to try to navigate that landmine? I mean, it's just they're everywhere. It's not an easy task to dissect 23 pages and make sure that just that portion of what is maybe a 110 page conglomeration actually gives you what you think you're signing up for.
Yeah, I think the best advice I could give is to say speed may close deals, but speed kills. Right? I mean, you're like, oh, we gotta close, turn the docs. How quickly? Hey, lawyer, when are you gonna turn the docs back? You know what? There need to be meetings upon meetings upon meetings when you deal with these docs. What does that paragraph mean? How does it imply? Okay, let's run the model based on that scenario. Cash trap triggers. I mean, here's like a simple one, right? So a cash trap essentially is when you deal with securitized lending where the servicer has to pay the bonds no matter what in order to compel the bonds to invest in these CMBS trusts, the CLOs, etc. They basically build in these cash traps that says to the extent something happens negative at the property, then money gets swept by the lender into a reserve. Maybe not a default to trigger it, but even a tenant doesn't give notice they're going to renew by a certain date. So the lender sweeps cash and all that, right?
Mm-hmm.
So how do you get out of the cash trap? Well, if you have 2/4 of it being better, sometimes let's say it's triggered by DSCR. So let's say one way to trigger would be if, let's say, the loan falls beneath a 1.25 coverage ratio, then if you have 2 calendar quarters of 1.3 or better, then you're good to go. So let's play this out. What happens if on January 15th, your DSCR, well, let's rephrase it. February 1st rent, your DSCR pops up to 1.3. So you won't cash it February 1st. But the next calendar quarter starts April 1st. So you literally got 6 months plus 2 months to get to the start of that quarter before you can start getting your cash back.
Mm-hmm.
How many people have modeled that out? Right? So think about it. If you need to show the lender 2 quarters, which would mean, let's call it April, May, June. That's quarter
Mm-hmm.
1. July, August, September, quarter 2, right? That's just 2 and 3, but still, right? And your income recovered February 1st. That means February and March, there's going to be extra cash swept. Then you need 2 full calendar quarters thereafter, right? So you're getting those extra
They're getting 8 months of cash sitting in a box.
8, yeah, instead of 6 months of cash, you're getting
Right.
8 months of cash, right?
Right.
And that makes a difference. Distribution, certainly, right? And where it also makes a difference is what happens if you have a problem that starts in, I don't know, the problem starts a month early. At the end of that second quarter, it drops again,
Mm-hmm.
right? And it affects it. What if you were able to not go based on calendar quarters, but 6 consecutive months? Well, the problem with that is that your reporting is monthly. Your reporting isn't quarterly. So then you got to put an allowance. You could submit monthly reporting if you'd like, right? And then what happens in that situation where you had an issue, like an abrupt issue, where you had a significant issue at the last the last month of the second quarter, right? And that affects your coverage ratio for the trailing 2 quarters. But had you instead timed it differently, then your quarterly reporting thereafter would actually show sufficient cash flow that you shouldn't go into cash trap again. So what if we did this monthly? Right? So this is a small thing, but what if you never recover from that decline again? So you got your money out of cash trap. So thereafter, the next test is going to be the next quarterly report thereafter. So if you time it significantly, you could literally pull 8 months of cash in between out, put in your pocket, where otherwise it's lost forever until the end of the loan because your loan never really got above that coverage ratio, right? And you have to
Mm-hmm.
wait until finance. And that money potentially could be put back into the property in some form or fashion via capital and sometimes leasing where, let's say, the cash sweep wouldn't otherwise be available for leasing. The point, and I'm talking some complex stuff over here. If someone that's never dealt with cash management, it's maybe hard to understand. But anyone who has and have dealt with this, knows exactly what I'm talking about. So flexibility both ways makes a difference. But your attorney is like, oh, what does it make a difference if it's monthly or calendar quarter? Give him a calendar quarter, no problem. Give him that. We'll get something else. We'll get rates. We'll get another 5 bips on rate. We'll negotiate the rate. It's like the rate's not as important as that, right? Because just on a net present value basis of having that money tied up until maturity, you gave more than that. So
Yeah, way more.
my point I'm making to you is like no one, I'm not gonna say no one, but most borrowers don't game out their loan doc clauses, and you
No.
need to.
No, they're focused on closing the deal, executing the business plan, and they'll deal with what may come when it comes. I think that is, for many operators, kind of the default mindset, for better or worse, and in many ways for worse.
Yeah, and I'll take this to the next step, and this is where it becomes a problem. So sometimes they go, well, I don't want to let my lender know that I have this issue, so I won't tell them that a tenant didn't pay rent. Like that, I won't go into cash trap. Well, there's two problems with that. Problem number one, when you submit financials, you're basically falsifying your financials. And if you do submit the financials properly, then they're saying, hold on, where did the money go? Where's the money? Hold on, we got an issue over here. Or if you submit it down the road and you delay your financials, then they're going to say, hold on, there was a cash trap all the way back to when. So now we're going to claw back that money and ask you to fund it. At which point that's at the penalty of recourse. You're going to have to come out of pocket to pay it anyways. Meanwhile, you distribute it to your borrowers. And distribute it to your investors. And the borrower was like, man, you know what I did with that money? I built out the space on the third floor, which we leased. Oh, thank you so much. But you still owe it to us because you misappropriated it based on the docs. You should have given it to us. So the rolling implications of third and fourth degree implications over here, it's like by not knowing is not a defense, so to speak, but by not knowing, you basically have started digging a hole for yourself that could have rolling implications because then you'll have a borrower that still doesn't want to read his loan documents, and he gets a notice from the lender demanding $750,000 to be paid, and he's like, "What are you talking about? Why should I pay it?" He's like, "I don't care." And the lender says, "Well, if you're not going to do it, we're going to come after you, and because it's a non-recourse loan, then we have to go after the property as well." So he starts foreclosure, and he basically starts suing, and then he challenges the foreclosure, but he still didn't read his loan documents that basically says that if you go with a frivolous defense in court, you're going to trigger recourse as well because his attorney screwed up on that as well. So then he continues fighting it, triggers more recourse, right? Ultimately loses the asset over 750K because he never decided to read his documents, which, by the way, were written badly to begin with by some guy who was a buddy of his who litigated for him another time who didn't know anything about securitized lending. And it's like, you know what? Services are bad. Like
Services
that.
are bad. Yeah.
That's the conclusion. These guys, they came after me. I did the right thing. I put money into the thing. You know what? You were a good operator, but you didn't read the rules of the game. And it's a
Mm.
challenge. And like sometimes, like with one phone call, I will save guys' buildings. I'm Superman apparently, but seriously, all it takes is one call, and you tell the guy, like, watch out, read your docs. I'm telling you, they're not in the wrong. They're going to take your property from you. Oh, okay, okay, okay. And you save it in time if they call. But a lot of people are like, nah, I'll call my attorney. Turns out, I want to litigate the heck out of this guy. Lender liability, tortious interference. Oh, let's go bankrupt. It's just like, and by the way, I'm not making this up. These are all real stories, and you could literally cry.
Well, I mean, look, it sounds like it's a rich ecosystem for you to come in, as you said at the top, and sort of translate, right? Like when you've got a developer saying, "Hey, this is lender liability, this is tortious interference. I'm going to throw this thing into bankruptcy." Like that's you're headed towards a brick wall pretty quickly.
There are guys out there that call themselves advisors that actually advocate bankruptcy. I mean, there's and they know that it's wrong, but they say, "Oh, hire us as a CRO, Chief Restructuring Officer, and we'll go and do it for you. We'll put into bankruptcy for you," as if that's going to make a difference, which it doesn't, right? But even I know a case where a guy decided to do it and he screwed up and whatever, and then he was going for financing on another property where he wasn't even the direct guy, but he was on the org chart, and this was a great property, and he was just getting his proceeds in CMBS, and the controlling class who was going to buy this is the same guy that was on the other loan that he put into bankruptcy. They saw his name on the org chart. They kicked the deal. Now he had to come out of pocket for a few $1 million more to actually finance with a different type of loan, right? And
Hmm.
that money that he didn't have readily available. because you become persona non grata. Like, you're a bad borrower. You're a guy when things go wrong. You're like, I'm not paying back my lender. I'm in a second position, but I'm going to make believe I'm in a first position. But you know what? Listen, if you have a good compelling case, nobody wants to throw good money after bad. Yes, sometimes people, they hope and pray and chase deals, lenders alike, but no one wants to throw good money after bad. So make a compelling argument. But if you're going to go use the courts and you're going to be a bad borrower, you're going to get a reputation. And as big as this world is, structured finance world, lenders, I mean, you could just do a LexisNexis search and see exactly where you showed up in litigation or what you did. And especially if people have a direct, intimate knowledge of how you've dealt. And you could say, oh, I hired a guy, he put me in bankruptcy. Like, doesn't matter.
Hmm. So how did you get into this? I mean, this is like, and for the audience, you guys put it on 0.75 play because you're sticking to your East Coast roots and going fast with the drinking from a
I
fire
listen to
hose over here.
podcasts at 1.5, 1.75,
Not for
and
this
sort
one.
of
I'm
like,
telling you, people
not
are
for
going to
this one.
slow it down.
Yeah, it's like slow motion. Yeah, exactly. Yeah.
How did you get into this?
2010. I mean, there were no deals to be done. What's a man to do? You got to feed the family. So I took out the CMBS docs. I broke open the books, as they say, and
Uh-huh.
I learned the intricacies beneath it, and I have some slight inherent talent, I guess, to problem solve, and went out and then just did it. Just went out and did it, right? And honestly, like, I'm a college dropout. I have no formal finance training, but now I basically, you know, negotiate legal terms. I advise some of the biggest of, I don't know, family offices, international investors, even institutions. Um, Work with the top, retained by some of the top litigation firms in the world to work on some of this stuff. And it's just a matter of like, hey, if you got talent and you're ready to hustle and ready to do the hard work, like, people want to deal, wheel and deal, right? They want to have dinners, they want to go out and party, they want to convince you to do a deal. That's great. I wasn't, I didn't get the lucky genes that, I could do that. I'm not a slick guy. I'm a very straightforward guy. My value add is my ability to be blunt and say things the way they are and not get myself shot in the process.
Mm-hmm.
So, that's what I do. So I hustled. I taught myself how to model, financial model. I taught myself Argus. I taught myself, you know, put together my first website myself, just tech stuff. And, if there's a will, there's a way, that's what it comes down to. And been able to succeed.
And,
I mean,
and
in the
it's
last, sorry.
no, go ahead. Go ahead. In the last.
I was saying last downturn, I had a 70% success rate, and I was shocked. And there's a matter of luck. There's no question, right? No one's that successful. I mean, even even Ted Williams. Um, but at the end of the day, like, if you work hard enough and you don't have an ego, you don't come in like you're the most important thing in the room, but rather you try to help. And okay, a big key to my success, to be very, very straight, big key to my success has been the genuine desire to help people, not out of the goodness of my heart, but just to educate people where I have knowledge and they don't. I get satisfaction when you could take someone who's literally broken and you could help them realize how to help themselves. Like, I don't want to do the work for you unless you hire me. You hire me, I'll do the work for you. But if I could talk to you and show you where you're wrong and you could have success, you call me up and you say, you know what, I appreciate it. You saved my bacon. To me, that's like, okay, I made a difference in the life of a guy that thought he was going to lose everything and he figured it out. For me, I appreciate it. It's a challenge for me, and I like giving back in that way.
I dig it. I mean, I think I know the answer to this, but I don't want to be overly presumptuous. Is your business largely countercyclical? When it's go times, you guys are slow, and when things start to slow, you start to go?
I'm somewhat countercyclical,
Uh-huh.
but yes. So So last downturn, we did very well. Then the spigot shut off. So we wound down the business in 2020. The calls came in, so we spun up the business. And just now getting in the rhythm right now, like 6 years later. So,
Right.
so that's really something that, yes, it is somewhat countercyclical. But what we're doing now is we're actively looking at investments, right? And I get calls from people all the time, like, how do we look at stuff together? How do we deal? Like, and most people, it's like, no, you're just not a fit. And the reason is because, like, I'm not doing deals the way you do deals, right? I'm harvesting opportunities. I'm getting myself into positions. I'm buying, derivatives that have impact. It is just like I don't want to make it sound like it's big, more rocket science. It is. It's not, but it's a slow play. It's not a big play. But the ultimate say, the point I'm making is that my goal is we're putting together a portfolio, right? That's the goal. The goal is coming out of this cycle, we're not shutting down. We're just gonna focus more on the investment side. Right now, we're focusing on the advisory side. Like, for example, we were awarded a mall and then a key tenant left, so we didn't end up going to contract. We were chasing a couple of major office buildings in New York City that ultimately we just had to pull out. We just couldn't get to the numbers that the lender wanted. In one instance, we didn't underwrite a certain portion of the building other people were, so we dropped the ball on that one. And another instance, they wanted property level um, property level value for debt, and they just weren't giving us the answers that we needed, nor did we get the access that we needed. So we say, you know what, we tapped out on that one after being in the best and final. So, we're chasing some of that stuff. We've bought some bonds, and we're constantly out there looking at some opportunities. Like we have, and our like a workout takes 12 to 18 months. Our opportunities, like here's the deal. Like I could tell you, Greenway Plaza in Houston just closed at par. Like we were chasing it for the longest time. The lender didn't want to take our deal, but we've put probably 250 plus hours into it. We had an approach to take the deal down, and the lender found someone to take it over our par. And this property is, it's hemorrhaging tenants. It's a disaster right now. But it's going to be what it's going to be. So we're looking at significant things, and we're attempting to make those deals, and hoping to focus on it. But what we're focusing on, and again, you asked me about cyclical, but like I said, we're looking to get into to add to our portfolio. We're part of a family office. We have over 50 assets right now, but we're looking to within the value add side of the business, which is the side of the business that I obviously would handle. Um, we're looking to get into assets that are the head of the market and not the tail of the market. I never want the tail to wag me, so to speak. I never want the market to wag me, if you will. I want basically to control what's going on in my markets. I want to be significant enough to be the first place that people go. So that means I'm not just buying a group of loans just because, so to speak, right? It's not what I'm going to do. So
Eh,
that's
You're
that's how
sharpshooting as opposed to buying like blanket purchase of some washed out sort of, you know, C asset in the C market.
yeah. Think of it as not only sharpshooting. Think of it as a sniper shooting at a moving target, right? So you got to lead it,
Yeah. Well, but
right?
let's go back to the start there where it was, you're counter cyclical. So, um, you've gotten into like, hey, we're seeing opportunity here, we see challenges here, but like, I think that you and people in the industry where you are have a very unique vantage point into the industry and the tides and the trends that don't make the headlines. So, like, where are we in, if you want to use the baseball innings of cycles, which is certainly overused, is distress increasing? Is distress decreasing? Are there more problem capital stacks? Are there less capital stacks? Are you getting busier? Like, what's the outlook for kind of where we are and where we're headed? Like, I have to imagine you're standing on a pretty unique mountaintop, seeing things that look different than what the average real estate practitioner might be looking at.
Okay, so here's where we are. So the buyers are the hitters, and are the sellers and the guys that have the assets are playing the field, right? We're in the fourth inning, every single ball we've hit has gone to the track.
Hmm.
Okay. And caught at the track. Like it's like, yeah, it looks like there's finally gonna be, oh man, caught at the track. What a catch again. Wow, that guy. And bases loaded 5 times and then struck him out. Right? Like literally, that's who we are, right? Inning wise, I think we're probably from a time perspective, like I said, like in the fourth inning or so. But nothing's happened. It's a scoreless game, right? Nothing's really happened. There's been, the defense has had like 5 pitcher changes, right? We've any wins we've had has been bunts, sacrifice flies. I mean, there's nothing really happening. And frankly, the defense is running out of pitchers. Um, don't have capital to chase their deals, right? I mean, the offense, there's so much power coming up, but they keep on like striking out, right, for new deals, right? And frankly, there's a whole new team waiting for the next round to take over, but the guy playing defense, they're just preventing that from happening. And our existing guys, we're just trying to like somehow put some runs on the board to sort of salvage this game to make it out to the next round, right? That's really what we're dealing with over here. We're dealing with buyers on existing owners of existing assets are cash poor. There's lots of capital in the market that's trying to chase things, but that's being affected by the fact that the guys playing defense are somehow related to the guys in the next round. And, the guys in the next round may have all the money, but if the guys in this round, the guys playing defense lose the game, they may tell the guys in the next round, we need you guys to actually help, come in for early training for our next year's season. So therefore you may not have that power to actually buy stuff once it hits the market. My point being, because a lot of people that have the capital are people that have exposure to existing loans, and because of maybe directly or indirectly even, the allocators that are expecting to get capital back are somehow tied into a lot of this new money that's coming to the table. I think once some of the balance sheets start moving around, you're gonna have more redemptions and you're gonna have a lot of issues. So I'm not advocating now, let's make it real from my analogy and the baseball analogy. I think because finance is a closed loop system, right? I got to pay back the loan so you can make the loan elsewhere, right?
Hmm.
Um, I think the more market price discovery we're getting and the more losses are going to be materialized, the less bullish some of that capital in the market is going to be. And it's really hard to know upfront how that's going to look. But so far, there haven't been that many substantive resolutions. There's been a lot of kicking the can, a lot of delaying, but not a lot of substantive resolutions. And it's really, it's not 100% that when those resolutions happen, that the capital that's out there is going to be as aggressive. And I think we've seen some of that where deals have come to market and they haven't realized the pricing that people would have assumed they would. So what happens then is that all the aggressive capital in the market says, I don't like the pricing, but I like the pricing minus 20%. So let me give you a loan against that new purchase. So then the equity becomes an issue. And that's where I think ultimately you have a challenge. If the equity doesn't exist, then it drops. Then when it drops into the level that the debt that the people who would have been the debt on the equity are comfortable with, then they'll go in and swoop in and buy it at that price. But the reality is that as you know, you start waiting for the market to catch up to you, the market runs away from you. It's like the guy that wants to sell a property for $100 and the bids come in at 90, says no deal. Then the market drops to 80 and he goes, I'll take 90. And market drops 70, says I'll take 80, right? And then all of a sudden something changes and something outside the system changes.
But
At
we're
this point,
but we're in a like try to say some of what I just heard back to you. There's a bit of a log jam. The buyers and sellers are playing ball. There's chatter, there's bids, there's offers, trades aren't happening, right? It's kind of a stalemate. If there are big marks to come, then you expect equity is going to become more there'll be more trepidation about jumping into the market, which could then exacerbate a downdraft. I'm just trying to make sure I kind of heard what you're saying. I think I got it.
yes. Yes, I think you're right. I think you're characterizing it well. And I think the ultimate point I'm making is that it's not just a supply and demand dynamic, right? There's so much more that needs to be determined because capital supply and capital demand is one part of it. Product supply is another part of it. But then there's other parts of it as well, and that has to do with, obsolescence. So I was running an analysis. So I was trying to identify how many loans, not how many loans, but what does the opportunity look like in the market relative to discounts to previous peaks, right? So you pretty much could get a sense of where institutional pricing was. You could get a sense of where trades occurred. You get a sense of where debt is valued at specifically in CMBS once it goes to special servicing. But what you need to then do is layer upon it the obsolescence premium. Like, what's it going to cost to renovate it? And then you compare that to replacement costs. And pretty soon the discount ain't really that big of a discount,
Mhm.
right?
Yep.
So that's also another factor to bear in mind. And that's thing that people realize once they dig in on a deal. So that's why you have to be really, really careful. And that's why, from my perspective, I want to deal with the head, not the tail, because if something's going to pop, I want it to be my deal, not that some other deal takes over the market and I got to stand the line behind them. So that's why we're not focusing on, oh, let's buy a bunch of row houses and, oh, a bunch, in some suburb of Boston, right? That's just not going to be exciting, you know, but if I could actually buy a specific tower in a really great market, then yes, if something's going to pop, it's going to be my building.
Mhm. I know you're gonna come up on a hard stop, so let's switch a little bit. I appreciate all that insight into the market. I think it's well, it's real. It's an interesting market. It's with that stagnation and stalemate has been persisting for a while, and I don't really know how it's gonna break, but it's an interesting time. It's a good time to be where you are, to be honest. I think you guys are gonna be very busy. Um, what about, mentors? Who's been influential in your journey? How anybody that sort of helped you? I love the idea of, like, how'd you get into it? It's like, oh, I rolled up my shirt sleeves and figured it out. I pulled out the documents and I read them. What a radical concept. But anybody that's helped you kinda get here that
Yeah, I mean, there's been a bunch of people. I think from a technology perspective, my first boss, his name is Ira Zlotowitz. He's been in the finance game for a while. He had a software CRM that was out there, and so that's the first that's one that was very helpful to me. My current partner, Dover Rabinowitz, is very helpful to me. When the game was up in 2016, 2017, I partnered with him on the acquisition side and just built out the business from there. Um, I think there's there are some people in the special servicing industry that was very helpful. There's one guy who actually we do work together right now on some workouts. Um, who's Kevin Donahue, who actually is retired, but for fun, he gets involved in some of the little workouts that we're doing. He used to run C3 in Midland, and he's
mm,
someone that when I was negotiating with, specifically there was a deal I was working on where a somebody who's in the same business as me, who's Deborah Morgan, really great. So she was on the other side working for him, and I was trying to figure that out. So I had meetings with him. He's like, just advocate for your client, but we had lots of great discussions, and that's somebody I have a lot of I really appreciate. Um, there's the partner that got me into business on this, Steve Hersko, less a mentor, more a partner. I think somebody, people that I've studied a lot. I've studied Bill Zeckendorf as to the excesses. I've studied, other, learned a lot. I think I read a lot of Winston Churchill. I take a lot from books because I don't, people that are in the process, you never really get a, in alive today, you never really get a real good read as to what the real story is. You just get the story they want to tell you. People you could read about is helpful. And I think one of the, like Winston Churchill's a good example. Like when he went to FDR to try to get a deal done, if you will, to try to get the US to help him. Um, he used what FDR said, if your neighbor has a fire, will you not lend them the fire hose to go and cut it back? So what he did was a great job of saying, hey, this may be my problem, but it's really your problem. It's the same thing that I do with the lenders, right? But he was able to eat, what, from FDR because FDR was pretty haughty as a person to start with, but FDR also couldn't just jump into war, and he had to, be standoffish a bit with Churchill. And he was ready to, like, bow down to him. Whatever you want, sir. Yes, sir. Right? He treated him like a god, and so he put his ego in check. And a lot of borrowers don't do that. So I learned that from him as well. Sam Zell is someone that I really admire. I had the hubris to write an article that called "New Graves to Dance On" that I have published, and we published a second Grave Dancer, the Grave Dancer Returns. But I pitched him on a couple of stuff once, so that was really cool. Just try to learn from people around me. I really do, and I try to learn from people who are not egocentric, people that are brass tacks and could actually educate you. Somebody that I really enjoy listening to as well is Howard Marks and his podcast. I know a lot of people,
Totally.
I've heard saying, like, I wish he was in business the same way he's on his podcast. I've heard from people, but I find his, some of his quotes are really, there's some, like, he's really great at coming up with some of these quotes. Like, I have literally an internal note that I share with my team that I think is just, is absolutely great. Like, I have a couple from Kevin Donahue is great. He's like, appraisals are a forward-looking science based on backward-looking data. Another one Kevin said, which is great, is like, just because you could doesn't mean you should. But
Mm,
Churchill, right? But Churchill's got a bunch that he spoke about back in the day. Like, the English critic would do well to acquaint himself with the inherent probity and strength of the American speculative machine. It's not built to prevent crisis, but to survive them. There's a few of these that are really, really good. The four most dangerous times in words in investing are "this time it's different." So John Templeton,
yeah.
right? There's so much. Like, I could. Well, he's a great one. Walter Deemer. He was a great trader in Wall Street. He wrote a book. This is the name of the book. When the time comes to buy, you won't want to. That's great. Like, these are, like, you learn from these people, and just it's so, like, I live my day based on these quotes. Donald Rumsfeld, "Unknown unknowns, the ones we don't know," right?
Yeah.
Bad people, bad things, that's me, right? It's just, there's, one last, I'll let you move on. He was 6 foot tall, and the average depth of the river was only 4 feet. He was drowned. Reverend Edward Latham. So there's so much, just I have so many of these quotes, but, when you learn from people who have gone through life, some of these their entire lives, right? And give these quotes, and then when you live through it, you say, "This is genius," right?
Yeah, it's gold.
So,
It's gold.
yeah,
Literally, somebody has put a breadcrumb on the trail for you to find, and when you find them, you can, you probably have to have the experience to have the uh, vantage point to appreciate that it is in fact gold. Otherwise, you just walk by it. But that the
yeah,
one you just threw out, which is when the time comes to buy, you won't want to. I mean,
yes,
OMG, like that
yes.
that is 100% the thing. Um, so I think you said 2010 is when you started, when you're like, "Hey, I gotta do something."
Yeah, yeah,
So
yeah.
so go back to, I have no idea what that looked like, but I can imagine there was a lot of elbow grease and long hours, and you're trying to skill up and get to a point where, your credibility is sufficient enough that somebody's gonna take you on as their advisor,
Oh,
right?
I gotta thank you on that one. Yes, there we go. I gotta thank someone, but continue, yes.
So Shlomo's in business. He's rolling, and now I think you have a team of around 10 people. And look, from all indications, it seems like you guys are short on time and long on opportunity. What's that like? How are you managing the transition from, please give me a shot, to like, oh my God, like I can't do all this work?
So the reason I got into the business, my attorney at the time was former in-house Citibank CMBS counsel, Amir Kornblum. He's my attorney still today, and I always thank him whenever I can for putting me in this direction. But you know what? Your results speak for itself, right? And you got to grease the wheel sometime, which is why I do a lot of social media marketing. But I don't say, "Hey, I'm the best." I actually tell people problems. I tell people the things I work through, and I talk openly about it. Initially, to the chagrin of all the go-getter syndicators, that I'm too much of a negative Nelly, but I was seeing things before they saw it, right? But yeah, I mean, I don't have to tell people that I'm great at what I do or give me a shot anymore. I had the cold call when I started, but it's just funny. "Hey, you need brain surgery? I'm a good surgeon. Here's my number. Call me." So I mean, that's
Mhm.
that's sort of how it was. But today it's just I'll give you an example. A REIT called me about one of their assets, right? And I happened to be introduced to them because I put out a white paper, and the head of asset management's like, "Send me the white paper." He saw the white paper and he's like, "Let me introduce you to the head of capital markets." Introduced you to capital markets. We had a conversation. He's like, "Okay," we spoke about the deal. He says, "Okay, let me get you an NDA to talk further." I get a message from another attorney who's been following me on social media. He's like, "Hey, Shlomo, the REIT called me. I told him I really like you." I'm like, "Wow." It's like, it's just you just put in the effort and the effects happen, right? And you got to be good at what you do. Here's the thing for me: you got to have empathy, absolute empathy, right? The guy on the other side of the table, he could be a nudnik, he could be, but at the end of the day, he's losing it. He's losing his project. He's potentially losing everything, and he's relying on you. He's coming to you with his, with tears in his eyes. It's in many instances, okay, like I don't know what to do, right? And you got to help the guy. And you got to figure it out. If you have empathy, and you understand that it's not like, oh, we're doing the best we can, or you advise the guy, okay, do something that's risky. No, it's as if it's your asset, and I do take it to heart, and it could be hard sometimes. But I really, really try to deliver for those people, and that makes it that people care. People care. It's not just somebody trying to do a deal. So that's thank God that's how the business has grown. And I just don't plan on changing who I am. And yeah, I'm a tough negotiator, and yes, but I'm not a snake, right? And I'm careful, and it's about the long game, and I won't compromise my ideals for anyone. But I'll be there for anyone that's legit. I'll be there for them, and I'll figure it out.
I dig it. I'm going to respect your schedule. It's caseinv.com, I believe. Is that correct, Shlomo? Shlomo,
That is
excuse me.
correct. Yes.
Yeah. So anybody wants to find you, because he's all over the webs, the LinkedIn, and there's the website. I'll leave it with you, Shlomo, for any closing remark. And thank you for taking the time. I appreciate it. Listeners, do the stuff of follow us, like us, subscribe, do all that stuff. It beats the algorithm. You've got the mic, Shlomo. Thanks so much.
Yes, and I appreciate it. Thank you so much for having me. It's very generous of you. And I guess my message to the average person is, whether you're under stress or not, if you haven't done this yet, take your loan documents, give it to an attorney to review, tell them to come back to you and talk about every single paragraph in it. You want to have a 4-hour meeting. You want to talk through how you need to operate your property. You want to talk through every single clause in there, because even if the lender didn't call you on it, if there's ever an issue, they're going to point to it to come after you from the day that something happened. Understand it, coach your management around it. Make sure you understand the implications of everything you do, because there's lots of landmines hidden in there, some of them that your lawyer planted for you, unfortunately. Leave you with a very quick story. I have a client came to me, and right in his carve outs, it says that if he didn't adhere to every term of their reporting section, it triggers full recourse on the loan.
Oh
Take
God.
that for a sec. You're late a day, or that's not doesn't conform to GAAP. And judges tend to enforce documents as they've been agreed to. So, like, get in front of your docs, review your docs, know ahead of time if you have an issue. The problem with go-go times is that you don't watch your flank, right? And then all of a sudden, boom, you fold it up. So just watch your back, and good luck.
Right on. Thanks, Shlomo. I appreciate it.
Pleasure. Thank you so much.